Hi, everybody, and welcome this week. This is Seth Martin, and this is Middle Class Investor. Well, you can see that really in the last couple of days of the week, the S&P 500 recovered and actually made a higher high this week. Um, you can see that right here. Um, it, I was expecting it to come up to this channel, this top line of the channel, and maybe it still will. It just hasn't yet, so maybe it comes up to there before it pulls back. Um, but after it pulls back, and it could pull back into this area here, we should see one more high, maybe just below this 2400 area. And then we should get a pretty decent pullback, if not, you know, some really serious topping looking action. So markets had a good run. Hopefully everybody's making some money. I've been making a little bit, not a ton, but I've been kind of picking and choosing where I've been getting in. So sometimes, when you're only taking a couple of positions, you just don't make as much money. But anyway, so the market, looks strong. This, everybody's all hyped up about Trump and everything's great and so on and so forth. Volatility, which is incredible, made a low here below 10, which I think I did last week. I went back like 20 years and looked at volatility. So you can see back here we were at 9.39, and it didn't get all the way to 9.39, but it did. It did get below 10, which is incredible. Very, very low volatility means a lot of complacency in the market. Complacency just means investors are sitting around going, there's nothing to worry about. We got this. It's going to 30,000 and beyond now that Trump's in there and we got rid of Obama. And the reality is, what we need to understand, this community of people, is that presidents and government really don't have a meaningful impact on the market one way or the other, except to either hinder the market or get out of its way. Now, for the last 8 years, Obama's done nothing but put the brakes on every aspect of the American economy. So maybe, I guess, to the extent Trump can, him and his administration can get rid of some of these anchors that we're dragging around, maybe can go higher. But the reality is it's been going higher. And a lot of times people confuse the market with the economy, and they say, well, if the Trump administration makes it easier for people to do business, then the market should go higher. But the problem is the market has been going higher. So, it doesn't generally go appreciably higher once it's already, very high. So I hope that makes it. Hope everybody understands that. And if you think about it, it logically makes sense too. I was just going to see where we are. Yeah, see, we're at we're just beyond the 2.618. And I don't know, maybe it does go here to the 377. The 377 is a pretty common area after a big pullback. But so is a lot of times I look for just this level right in here. But you can see we reached that level back in 2014. So it just, if we look at this one, see where's the low, right there. This just barely went to a new high. So I don't know. I think there's a ton of risk, but the market can remain irrational for for very long periods of time. There's a saying that the market can remain irrational longer than you can remain solvent. And what that really means is let's say that I say, well, I'm going to go short here. I'm going to short the market right here. Well, the market can remain irrational for maybe 2, 3, 4, 5, 6 months, 12 months. And my short position is just losing money, losing money, losing money, losing money. So that's what that saying means. So there's what drives the market is just, people's enthusiasm for buying and selling stock. There's a lot of talk about new money coming into the market and things like that. That's not really what happens. I mean, there is new money coming into the market, but the stock market is not pushed up by new money. You can actually have no new money in the market, and just existing money in the market, traders can trade back and forth and bid prices higher. In fact, that is what happens a lot of times. So there doesn't have to be new money in, but anyway, the S&P, the reality is, the facts are, it is above this resistance area. Get that off the screen. It did break out of that resistance area and then retest it, and then it has moved off of it. So if I had any new money, if I got $100,000 bonus or something and was antsy and trying to figure out what to do with it, I would not put it in the market. But if you've already got a position in the market, you've already got money in your 401k or whatever, we probably want to just leave it there until we see some evidence that this is starting to top. Hopefully that makes sense. So, I always look at the 13-week Treasury, and then we look at the 10-year Treasury yield. The 13-week Treasury is still trading above this 0.035 area. And it could do that for a while. I mean, this is not uncommon. Look how long it stayed in this zone right in here. But as soon as the 10-year Treasury makes its next leg up, which we're going to look at right now, then this short-term yield will follow. So, and it doesn't require the Fed to raise rates in order for that to happen. So what are we looking for here on the 10-year Treasury? Well, we're looking for, we've got, well, hold on, let me back out. We got this move up, pretty good move. This is pretty strong, and this looks like a bottoming kind of action. You got, you can kind of see how this looks the same as this, but then this doesn't look anything like these two here. So, and actually three, this goes back a ways. And so this is likely the first move off the bottom. So what we're looking for there on the first move off the bottom is we're looking for a pullback at least to here. Okay, so maybe even to close this gap. And sometimes even maybe the midpoint of a large candle tends to be support. So I would look for, move somewhere. I mean, this is a big range, but somewhere in here. Okay. Now, if we wanted to use Fibonacci and kind of estimate it better, let's do that. Let's come off this low here and then go up here and get a fib extension. See how the 1.61 is right there on the close of the gap. I would say that's a pretty good target. And once it pulls back to there, probably want to be out of your bond funds. Now it could make something along the lines of a more complicated or more prolonged pullback, and that might look something like let's get some white space here. That might look something like like this, where it pulls back to here, let's say, and then rallies up. And then you have another kind of ABC where it pulls back even lower. So we've got an ABC here, and then you get a retrace of the ABC, and then another ABC. That could happen. That's why I was saying a lot of times the midpoint of a large candle will provide support, and then also a gap generally The market tends to want to go back and backfill a gap before moving higher. So I would make sure. I mean, you can wait you can take a chance that this isn't the next move up, that this is just counter trend still, and you come back and retest. But there's nothing to say that this couldn't just keep on going at this point. So, you know, that's the risk reward, right? If you wait for more evidence, well, you're taking on more risk. So just keep that in mind. Let's see, that's the 10-year Treasury. Let's look at the Dow, because the Dow kind of broke out of this upward trending line here and back tested or backfilled and tested right off of that. But the Dow and the S&P are kind of doing the same thing, but the Dow's a little bit stronger. So same thing here, you know. I mean, you could see the Dow push up a little bit here. No guarantees, but you could see it push up a little higher and then trade back down maybe into this area here before making a new rally high. So, and there should be a lot of, I mean, there already is. There's already a lot of noise, you know, people on TV, oh, this is great. You know, they're feeling good about Trump. They're feeling good about the market. Everything's great. That's when you need to be on your guard. When everybody starts talking about, you know, how great things are, that's when you really need to be on your guard, because that's the situation where everybody's on one side of the boat, and boy, can that boat flip over quickly. So be careful with that. All right, let's look at Germany. Germany, you know, still hanging in there. It's the strongest economy in the EU, and probably the most financially secure, although they do have, you know, there's problems with Deutsche Bank, and of course Italy has its banking problems. And these problems continue to mount. They haven't gone away. They're just not in the news. So, and these are the type of problems that bleed over into, you know, just like our financial crisis bled over into the rest of the world. You know, a failure of Deutsche Bank or, you know, something like that could bleed over, and actually is likely to bleed over into our banking system as well. All these banks are interconnected, and so there's no such thing as just one bank getting sick. I mean, one bank getting sick turns into kind of an epidemic for the other banks. All right, so, and the Russell's been, you know, slightly weaker. This is the Russell. It's been slightly weaker than the S&P here as of late. Here's the S&P again. So let's jump over and look at the dollar and some currencies. You can see here the dollar had a pullback, pretty good pullback. Let's shrink that down a little bit and drag this way. So we had a run up into this resistance area. Actually didn't hit it, which means it could still go a little higher. So you could have a situation, you know, where the dollar is breaking out to new highs, pulls back to here, and then actually makes a higher low and starts to go down. So the dollar doesn't have much left in it. It had a pretty big run, you know, all throughout. Whoops. Let's just look. Since the financial crisis, I mean, it had kind of an up and then a test. So there's kind of, you know, an up move, a test, you know, to a higher low, more up move, and then this huge rally. And it generally, when you get to the end of the trend, once you've had a big move like this and you start seeing it like that, you know, this could mean this is the last upward move in this trend. And so if that's the case, we should expect a pullback into this 90, 91 area in the US dollar. But after it goes higher. And when it goes higher here, what we're going to see, we should see, is a corresponding decline in the euro. So let's see, do I have the euro? Thought I did. Here it is right here, euro US dollar. So you can see that we're right there now. You know, the next move for currencies in the euro and in the dollar euro combo would be for the euro to fall probably past this low made on the 17th. So when you get a chance, you should take a look at that just to make sure lines up with your analysis. You can see it kind of looks like this was the end of this trend, but then you have a pretty strong move. I think I read somewhere this was like 45%. So, oh no, I'm thinking of oil. Oil was 45%. That's what that was. Speaking of oil, let's go ahead and look at oil real quick. Yeah, this move from the bottom here to up here in oil was like 45% or 48%. It was a huge move. I mean, if you were long oil here, you would have made a ton of money. But you can see that it's starting to get kind of tired and peter out a little bit, and that's perfectly normal. These stocks and currencies and futures and stuff, they even if there's no selling pressure, they can ultimately fall under their own weight if there's not enough active trading going on in these instruments. Let's see, what else did we looked at? US dollar, Japan. Okay. We can look at silver. Silver, you know, had this huge pullback after that huge run up in the first decade of the millennium. But then we had this big pullback, and now we're starting to get a little bounce. And this will be a three-way move, but may look totally different than this. In fact, it is totally different than this. So. Silver and gold kind of moved together, but I think I mentioned last week that if you were looking to own physical gold or silver, that it was maybe a good time to go ahead and take a position in there. And it does appear to be the case that you know, next stop for gold is up there where that yellow, somewhere up in this area here. Gold or silver, they move the same. So I've got a silver chart up, but I was talking about gold. Let's see. We looked at the dollar. We looked at the S&P 500. What to watch out for? Let's talk a little bit about what to watch out for. I think what you watch out for is, you know, the higher low situation. So let's say we come down. You know, we pull back into this area here, and we pull up to there, and then you pull back past this point right here to right there. This is potentially this could be the end of the trend, right? So you want to be preparing for that. So what you're looking for is a pullback into a higher low. So that would be, let's say, a pullback into here. Whoops. I don't know how to, let me take that back off. I want to make straight lines, but it wouldn't. I guess I hit the wrong button or something. Oh. So let me try this again. All right. There we go. So, you know, if we get let's say we get a pullback, okay? Maybe it looks something like this, little ABC, pull back to here, and we start to rally, and we do make a higher low. In other words, we take out this high right here. Then if you go back and count all this, this is the end of 5 waves of like 3 or 4 or 5 degrees of trend. So that just means that we're going to have, a pretty rapid pullback. So let's say we pull back to here pretty rapidly and then retest, but do not make a higher low. In other words, this, this high right here is lower than this high back here. And when that happens, that's potential for the market to top. So you want to maybe be on the sideline, especially given that we've had an 8-year bull market. We can actually count 5 waves of trend, 5 waves in here. And anytime you can count 5 waves, you're at least coming back to the previous 4th wave, which is right here. So, some sort of zone like this you're coming into. So keep that in mind, and just try not to listen too much to the noise, except maybe for entertainment purposes. It is interesting to listen to all these people talk like they can do something and do something positive for the economy, for the financial system. The problem is there's so much damage to the financial system. It's just unlikely that government's going to do the thing they need to do. So with that, we need to protect ourselves. That's what the purpose of this YouTube channel was, is to give somebody in the middle class a way to make a decision if they have to. Now, if you don't want to make a decision, you want to sit down with your financial guy and make your decisions, that's fine. There's nothing wrong with that. But just have a strategy. Have in your mind that if I go below here, let's say, then I'm gonna step to the sidelines. Just have that decided already. That way, when you do get there, you don't have to think about it. You don't have to go, oh, I don't know, what am I going to do? What am I going to do? You will have already decided, if it goes here, if it goes past here, past this line, I'm out. I'm just going to sit on the sidelines. Whatever happens, happens. There's absolutely nothing wrong with that. So keep that in mind. All right. I guess that is it for this week. I was just looking through the list here to see if there's anything else we wanted to bring up. And there's other stuff, but right now, we could look at some of the leaders, some of the stocks that were leading for a long time, like Amazon. You can see, so let's look at Amazon. This is maybe a good example. Let's say Amazon, see they had a high here and it made a move down and it made a lower high. Now, if Amazon continues down from here, if it continues down from here, it'll probably go to there. And then this could potentially be an ABC, ABC, in which case you'd be looking for a long position this way. But it's also a lower low. So, there's always a potential that this right here could be the top and this could be the first move down. So you just have to be careful about that stuff. Normally you could put some sort of pattern like that, and when it breaks out and pulls back, you could enter, let's say right here, and follow it up. But it's harder and harder to do that once it's already moved. Once it's moved, you look at your account, you see your account losing money, and the emotions start kicking in. So, but this is a good example of potentially a lower high. So you had this move down, you got something that looks fairly counter trend, kind of ABC, and you got a potential lower high here. So that's what we're looking for. So let's look at for a topping kind of situation. That's what we would be looking for. Let's look at Facebook. So Facebook is also making Facebook made a new high. So Facebook made a new high. So let's not dwell on Facebook. I'm trying to think of what else. Google, GOOGL, also known as Alphabet, which is weird. I don't know why they call themselves that. It actually made a higher high, so it's kind of ahead of, Amazon and some of the others and Facebook. Anyway, that is about it for this week, everybody. I don't want to sit here and ramble. There's other things we could talk about, but the really important stuff, we still haven't seen evidence of yet. So I think you just sit tight, you kind of keep your eyes open, you monitor it, and we'll go from there. And hopefully, if there is a need to get out, hopefully, we can help you navigate that decision process right here on the Middle Class Investor. So, all right, if you want to follow me on Twitter, it's @InvestorClass. Of course, you can comment right here on the YouTube channel. If I get the comment, I will definitely respond so that everybody can see it. And until next time, you guys take care. Be good.